Here's a question that's been keeping me up at night. Are we about to watch the US economy shrink right before our eyes? Think about what's happening right now. Mass deportation, pulling workers and consumers out of communities, tariffs flying left and right, military troops deployed domestically in ways we haven't seen in years, and our largest trading partners are hitting back with counter tariffs. So I have to ask, when you add all this up, what does it actually mean for the economy? Forget the political talking points, forget the headlines. Let's do the math, the actual GDP math. And let me tell you, after digging through government reports, think tank studies, and market forecasts, the picture that is emerging is quite eye-opening. Economists measure the entire US economy with a simple formula. GDP equals consumer spending plus business investments plus government spending plus net exports. 4 pillars. That's it. And here's the shocker. Every single one of these pillars is under pressure simultaneously. Consumer spending, it's weakening. Business investments, delayed or cancelled. Government spending, rising but in low growth areas. Net exports, hammered by tariffs and retaliation. So let's walk through each one of them one by one. By the end, you will know exactly why the US is staring at contraction risk in 2025 and whether this is mild turbulence or a policy-driven recession. Let's talk about consumer spending first. It's the first and the biggest hit. Consumer spending makes up about 70% of US GDP, the single biggest driver. And here's what most people miss. Immigrants aren't just part of the labor force, they're also major consumers and taxpayers. The Council on Foreign Relations estimates undocumented immigrants alone have $254 billion in annual spending power. That's $250 billion flowing through US businesses, grocery stores, restaurants, housing deportations, and housing. Deportations rip that demand out of the communities. Take Ottumwa, Iowa, a meatpacking plant lost 200 workers due to status issues. That's not just 200 jobs, it's 200 families, maybe 6 to 8 million in annual local spending gone overnight. Multiply that across states and you see the scale. And deportation hits small business owners too. Over 157,000 undocumented immigrant entrepreneurs run local shops and services. Deportations aren't just removing employees, they are shutting down neighborhood businesses. Now layer tariffs on top. Tariffs act like a hidden tax on consumers. Remember the washing machine tariffs in 2018? The average price jumped by nearly $200. Same thing now. When goods cost more, households cut back elsewhere. And here's the quiet drag nobody's talking about. International tourism. Before COVID, foreign visitors spent $233 billion annually in the US. New visa fees of around $250 just to apply and strained relations with neighbors like Mexico and Canada make visiting less attractive. That's tourism dollars slipping away. So consumer spending is under attack from 3 sides. Fewer consumers, higher prices, and lower foreign inflows. Historically, when consumer spending weakens, recessions follow, and it's already visible in retail sales data, which is flattening in mid-2025. Business investment is frozen in uncertainty because it constitutes around 17% of GDP. Normally, this is about optimism, companies building factories, buying equipment, hiring workers. But right now, that confidence is crumbling. For example, Samsung's massive semiconductor fab in Texas, originally targeted for 2024, is now delayed to 2026. Why? Well, it's because of tariff uncertainty. How do you plan a multi-billion-dollar project if material costs swing wildly with every policy shift? And tariffs aren't small anymore. The average US tariff rate went from 2.5% in January to 27% by April 2025, the highest since 1938. And many experts peg the average cost of tariff to be around 17.5%. I mean, this kind of volatility kills long-term planning. The construction sector is already reporting pain. 16% of firms say projects are delayed or cancelled due to tariffs. These aren't backyard reservations. We're talking about large-scale industrial and infrastructure projects. Meanwhile, we also have troops deployed domestically for enforcement, which pulls away resources from defense contractors and training pipelines. Research shows military spending creates fewer jobs per dollar than education or infrastructure. And now even that spending is redirected towards enforcement operation, which has even weaker multipliers. Markets are noticing. BlackRock, one of the world's largest investment firms, cut its 2025 US GDP growth forecast to 0%. And the New York City comptroller warned of a potential 20% market drop by year end. Yes, some businesses are investing in automation and reshoring, but that's capital intensive and long term. In the short run, it just adds to investment freeze. When you combine uncertainty, higher costs, and weaker returns, business investment looks paralyzed, and that drags growth lower. And if the investment go into AI enabled and robotics enabled facilities, then it's not increasing employment in any way. And that could also lead to a lack of spending from the individual customer. Now let's go and have a look at what's happening with the government spending, which is the third pillar and accounts for around 17% of the GDP. Now, here is the paradox. Washington is spending more, but not in ways that grow the economy. Immigration enforcement alone is set for 25% budget increase, up from $7.7 billion. Analysts estimate total deportation costs could exceed 100 billion if fully carried out. But not all spending is equal. Infrastructure spending has a multiplier of 1.5 to 2, meaning every dollar generates $1.50 to $2 in GDP. Education spending is even higher. But enforcement spending, well, detention centers, transportation, administrative overheads, much of that money goes to private contractors and doesn't ripple out the same way. Core Civic, a private prison operator, reported a $2.1 billion in revenue in 2023, much from immigration detention. That's government money flowing into low multiplier users instead of addressing America's $2.6 trillion infrastructure backlog. Worse, the Committee for Responsible Federal Budget estimates this enforcement surge could add 50 to 100 billion annually to the deficit. Larger deficits mean higher treasury issuance, which could crowd out private investment by raising interest rates. To be fair, some argue stronger border enforcement reduces long-term social costs and creates stability for legal labor markets, but those benefits, if they materialize, are years away. Right now, government spending is being funneled into activities that produce little immediate GDP lift. It's misallocated fuel. Finally, net exports, the fourth pillar. In theory, tariffs should boost domestic manufacturing by making imports more expensive, but retaliation cuts both ways. On February 1st, the US slapped 25% tariffs on almost all goods from Mexico and Canada, except oil. Canada fired back in March with $29.8 billion worth of US exports hit by counter tariffs. Brookings data shows Canadian transport export to the US fell 70% and motor vehicle exports dropped 53%. But here's the kicker. US exports to Canada fell even harder because of that retaliation. The Yale Budget Lab found US manufacturing output rose 2.1% under tariffs, but construction fell 4.1% and agricultural dropped 0.8% overall. Exports are projected 18.1% lower. Even the industry's tariffs were meant to protect, like steel and aluminum, are suffering. US steel exports to Canada now face counter tariffs. US protected domestic producers at home, but made them less competitive abroad. And timing couldn't be worse. With the US co-hosting the 2026 World Cup, cross-border travel and spending should be a huge economic tailwind. Instead, the trade spat and visa restrictions risk dampening one of the biggest tourism opportunities in the decade. The Tax Foundation estimates retaliation on $223 billion of US exports will trim GDP by 0.2% and cost $146 billion over the next 10 years. That's a structural drag on growth. Now let's tally it all up. Consumer spending squeezed by deportations, higher tariffs, and tourism declines. Business investments frozen by policy volatility, project delays, and market pessimism. Government spending rising but poorly allocated into low growth enforcement. Net exports shrinking under counter tariffs, but some manufacturing gains. 3 of the 4 GDP pillars are under outright pressure, and the fourth is misallocated. The Peterson Institute estimates deportations alone could raise prices 1.5% to 9.1%. Yale's Budget Lab projects 0.41% long-term GDP contraction. BlackRock says growth in 2025 is basically zero. Put it all together, and the contraction this year looks highly probable. And now, I think I would like to draw out a conclusion here. I think what makes this downturn unique is that it's not triggered by a pandemic or an oil shock or a financial crisis. It's policy driven. Effectively, US is sanctioning itself while competitors seize market share. For households, this means higher prices, weaker job creation, and possibly higher taxes down the road as deficits widen. For investors, it means more volatile and a narrower rally concentrated in defensive sectors. Remember, the stock market is not the real economy. Yes, some argue this pain could build a stronger domestic base in the long run. Maybe. But in the near term, 2025 to 2026 looks like contraction territory. The data says so, even if the politics don't. Now, my question to you is, what about where you live? Are local businesses cutting back or raising prices? I would like to hear from you what you are seeing. Drop your comments below. Well, friends, thanks for watching this video. If you have not yet subscribed, why not? Can you please subscribe and help grow the channel? And also remember, it's a very easy thing for you to press the like if you have liked this video. I put a lot of effort into it and I try to continuously improve. And I hope you like my videos. Please press the like because it helps YouTube distribute this video to more people like yourself who like content like this. You'd be doing a big favor to me and the channel. Thanks and have a great day, my friends. I'll catch up with you again in the next video. Have a great weekend. Bye for now.